I haven't started yet, eh? Welcome everyone to this broadcast on FAC3704. Today we're going to be looking at Learning Unit 1 in your study guide, and hopefully you all know that Learning Unit 1 refers to consolidations at the acquisition date. We're not going to be covering everything that's in your study guide, but we're going to be taking a few of the important things from your study guide and covering those today, and hopefully allow you to get a better understanding of them in the end. Please note that if you watch this broadcast, there's something you don't understand, you are more than welcome to contact us. You can come and see us in our offices. We are located in the AJH Van der Walt building, our Pretoria main campus. You can phone us, email us, but you are more than welcome to contact us. Okay, so let's start. How are you going to contact us? You can phone us on 012-429-4250. You can also send us an email at FAC3704@unisa.ac.za. Mrs. Scott, myself, Mrs. Jordan, Mr. van Staden, and Mr. Hua are all your FAC3704 lecturers. And as I mentioned earlier, you are welcome to make face-to-face appointments with us. First of all, before we start the consolidation process, we need to know when must we consolidate. So how do we know when we must consolidate? Well, IFRS 3 is very specific. IFRS 3 tells us when there is a business combination. Now, what is a business combination? Well, according to IFRS 3, a business combination is a transaction or other event in which the acquirer being the person who's buying the shares or acquiring the assets, obtains control. Now, I've put that word in red because for this module, the word control and the definition of control is essential. So, obtains control of one or more businesses. Going further into the definition, what is control? Now, if you look at the bottom of my slide, I've said NB for theory questions. Please note that the definition of a business combination, as well as the definition of control, is extremely important. We can ask you theory questions about it in exams and in assignments. So what we can do is we can give you a scenario. I'll do a little scenario with you just now, and ask you a theory question on, does X control Y? And you will need to take the definition of control step by step, make sure that all the requirements of control are met, and then conclude whether X has control over Y. These theory questions normally count about 8 to 10 marks. So do you see that a straight yes or no answer will maybe get you half a mark? That the rest of the 7.5 marks are going to be for taking each step of that definition, applying it to the information we give you, and then finally concluding, yes, you have control, or no, you don't have control. So let's have a look at each of these steps of the definition. Control. Important. All three must apply. So power, exposure or rights, and the ability. I'll go into detail now. All of those three must apply. If you only have power but not the other two, you do not have control. So let's have a look. What must apply? You must have power over the investee. Now, what is power? IFRS 3 gives us the definition of power. An investor has power over an investee when it has existing rights that give it the current ability to direct the relevant activities of the investee. So if you meet all three of these, you will have power over the investee. Then, if in addition to power, you have exposure or rights to variable returns, and you have the ability to change, determine, affect those returns through your power. If you have all three of those, then you have control. Let's look at an illustration. Big Limited owns 1% of the issued ordinary shares of Small. Okay, 1% is not very much. So they own 1%. Who owns the other 99%? The other shareholders. Additionally, we give you information that the relevant activities of Small, so all the relevant activities of Small are directed by its board of directors. So Small Limited has a board of directors, and all the relevant activities are decided by this board of directors. Big Limited can appoint 2 of the 3 directors of Small. Why is this important? What happens if the directors of Small Limited want to do one thing, but Big Limited would rather have them do another? He can appoint 2 of the 3 directors, can't he? So all Big Limited does is say, no, Mr. X and Mr. Y, you are now off the board of directors. I'm putting the people who will vote with me, Mr. A and Mr. B, onto your board of directors because I know that Mr. A and Mr. B will vote as I tell them. So do you see that because Mr. A and Mr. B, 2 of the 3 directors, will vote as Big Limited tells them, Big Limited in that way can direct these relevant activities of Small. So with that information, does Big Limited control Small? Once again, we can't give a simple answer. We can't say yes or no. We need to take every step of that definition and discuss whether each of those requirements are met. So first of all, does Big Limited have power over Small? Remember, if we think back to our definition of control, that was the first thing that Big needed to have, was power over Small. So, in order to have power, you must have existing rights. Does Big Limited have existing rights? Yes, he has the existing right to appoint or remove those directors. Does he have the current ability? Yes, he does have the current ability. If he decides today he wants to appoint Mr. A and Mr. B over X and Z, he is allowed to do that with immediate effect. The third part of the definition is to direct the relevant activities of Small. Yes, as we said, if Big puts Mr. A and Mr. B on, Big can tell Mr. A and Mr. B, you two have to vote this way or that way at the meeting. And by doing that, Big Limited definitely can direct the relevant activities of Small. So conclusion is, Big Limited definitely has power over Small. So if we go back to my original slide where I had the definition of control, I've said, okay, does Big have power? Yes, he has existing rights. Yes, he has the current ability. Yes, to direct the relevant activities. So, yes, he has power. However, I can't stop there because all 3 must apply, not only power. So let's have a look at the other 2. Does Big Limited have exposure or rights to variable returns from its involvement? Remember, not fixed returns, variable returns. So returns that change. And the answer is yes. Big Limited has 1% ordinary shares. So what happens when Small Limited pays dividends? Big Limited will receive 1% of those dividends depending on how much dividends were declared by Small. Also, Big Limited has an investment in Small. Depending on Small Limited's profitability, the value of his investment in Small will change. So do you see, those are already 2 variable returns that Big Limited receives from Small. So my conclusion is, yes, Big Limited receives variable returns from his involvement with Small. Back to our definition, then I can tick the second box. Yes, he has exposure or rights to variable returns. And finally, does Big Limited have the ability to affect those returns through its power? And our answer is yes, through the following ways. Big Limited can use his influence to determine the amount of dividends to be declared. Also, because Big Limited directs the relevant activities, those relevant activities can either be good decisions or bad decisions. Good decisions may help increase profitability, which will increase the value of Big's investment in small. So do you see, these are two ways that Big Limited has the ability to affect or change or determine the amount of returns that he receives from small. So now if we go back to our definition of control, we can now tick the last box. So when all of these boxes are ticked, I can then say that Big Limited has control over small. And the next slide will tell you why this is so important. Why is it important? Why do I need to know whether one entity has control over another? Because this determines whether that entity that you have control over is a subsidiary. If you have control over another entity, that entity is your subsidiary. If you do not have control over an entity, that entity is not your subsidiary. And remember, you only consolidate when an entity is your subsidiary. So do you see how essential it is to know for this module whether you have control over an entity? Because it determines, first of all, whether that entity is a subsidiary of yours, and second of all, whether you should consolidate or not. And as you know, this module is all about consolidating. Now, if you have a look at my little diagram that I've drawn here, I've got Big Limited and I've got Small Limited. Now we know that Big Limited has control of Small Limited. So why do we consolidate? We consolidate to show investors what the financial statements would look like if Big and Small Limited were one entity. That is the essence of consolidations. To show investors what this would look like if Big and Small Limited were one. The basics of the consolidation process. If we start again, we've got Big and again we've got Small, and we want to do the consolidated statement of financial position. It's very important to remember that with consolidations, you will always add 100% of the assets, 100% of the equity, and 100% of the liabilities. That's your starting point. So you start the consolidation process with 100% and 100%. Do you actually own 100% of this subsidiary? No, you might own 50%, you might own 1%, you might own 99%. That is irrelevant. When you bring in the assets and liabilities and equity to start the consolidation process, you will always bring in 100, 100, 100. Then, I just want to switch to the whiteboard quickly. Okay, so here's our Big Limited and our Small Limited. We are drawing up financial statements as if Big and Small were one entity. We know that we need to add 100% of Big to 100% of Small. That is always our starting point with consolidations. So if, for example, we take our statement of financial position and we start with our asset section, we are going to say 100% of Big plus 100% of Small. The same with the liabilities, 100% of Big plus 100% of Small. So if you look at this, we've got 100% of all the assets and 100% of all the liabilities. How do we show our investors that maybe, let's say this was 80%, that you don't actually own 100% of small limited, you might only own 80%. We've included 100% of all smalls assets and 100% of all smalls liabilities. So how do I show my investors that yes, I've included 100% and 100%, but actually I only own 80%? You do the split in the equity column. So what you will have in your equity column is you're going to have the equity that belongs to the parent, and you're going to have a separate line item called non-controlling interests. And this non-controlling interest line item is going to show 20% of the equity of small limited that you as big limited group do not own. So this is how you show. So remember, never 80%. We have a lot of students who put 80% of every line item. No, never the percentage you own, always 100%. But then the question is, but then how do you show your investors that actually you only own 80%? Well, you've got a different line item under your equity section called non-controlling interests, where you show that the other shareholders, i.e. the non-controlling interests, own 20% of it. If Big Limited did indeed own 100% of small, my non-controlling interests here would simply be 0. But because the non-controlling interests actually own 20%, 20% of small's equity needs to go under the non-controlling interest line item in the statement of financial position. If we have a look at our statement of profit and loss, once again, we've got all our line items: revenue, cost of sales, other income, there'll be other expenses, income tax expense, and I'm going to include 100% of my subsidiary plus 100% of my parent plus what percentage of my subsidiary? Not 80, not 99, 100%. Always 100%. But do I actually own 100%? No, I might own 80%. So if we have a look at our statement of profit and loss, here I've got all my line items: revenue, cost of sales, other income, other expenses, income tax expense. Now for all of these line items, I'm going to include 100% of my parent plus 100% of my subsidiary. Do I actually own 100% of the subsidiary? No. Let's say, for example, I actually only own 80% of the subsidiary. So how do I show my investors that, yes, I've brought in 100% of the profit, but I actually only own 80? I split the profit at the bottom of my statement of profit and loss, and you've probably seen it before, where I say profit that's attributable to my parent and profit that's attributable to my non-controlling interests. This is where I show my investors that actually the non-controlling interests, the other shareholders, own 20% of the profit of the subsidiary. Okay, so 20% of the profit of the subsidiary is owned by the non-controlling interest. Who owns the rest of the profit? The parent. So this is always the balancing figure. Okay, so let's say after I've added 100%, I get a profit of 20 Rand. My subsidiary made a profit of 10 Rand. And my balancing figure, 20 Rand minus my NCI, is going to give you my balancing figure. And this is the profit that's attributable to the parent. Okay, this is very important. When we write exams, we always get students who put 80% of the subsidiary's profit at the top. Never 80%. Always 100%. And you show your investors at the bottom that you actually don't own that you actually don't own 100, you only own 80%. Okay, so where do consolidation journal entries fit in? Students don't like consolidation journal entries. In fact, some students say they're scared of consolidation journal entries. And I want to show you that consolidation journal entries are very important. You can't spot them out. You need to know them. We can either ask you, they're a very good way to understand, to make sure you understand if you can do the journal entries. And that is why we like to ask journal entries. Often in an exam, we will ask only the journal entries. So we've often asked a question of 40 marks where we only ask the consolidation journal entries. So if you don't know the journal entries, you will probably not do very well on that question. Okay, so please make sure you know your journal entries and make sure that you understand them. Okay, I'm going to tell you where the journal entries fit in. When you start the consolidation process, again, we start 100% and 100%. How do we get from 100% to our consolidated financial statements? There's only one thing we do. We pass consolidation journal entries. So how do I get goodwill into the consolidated financials? With a journal entry, specifically the journal entry you do at acquisition. There's no non-controlling interests in either the separate financials of big or small. So how does that get in there? I pass a consolidation journal. I need to eliminate intergroup profit between big and small, don't I? Because if big and small are one entity, which is what I'm trying to do, can you sell to yourself? No. Can you pay a dividend to yourself? No. Can you sell land to yourself? You can't do any of these things. So I need to take them out of my consolidated financials. And how do I do that? Consolidation journal entries. So do you see how important it is to be able to do consolidation journal entries? Because when you are working as a financial manager one day and you need to consolidate, you're going to start by adding 100% of the TBs together, and then you're going to have to pass consolidation journal entries to get to the consolidated financial statements. On this, I quickly want to do an example of a consolidation journal entry, but please note that consolidation journal entries are covered extensively in your group statements textbook. So you'll need to work through the chapter on intergroup transactions very carefully, because consolidation journal entries, like I mentioned before, are very important. Let's say, for example, that I have two entities, one entity controls the other. So let's call this, just for purposes, A and B. A Limited controls B. So I need to consolidate A and B. When I consolidate, I'm drawing up financial statements as if A and B were one entity. A Limited sold a piece of land to B. So let's say A Limited sold land to B. A Limited originally purchased the land for 100,000 and sold to B Limited for 120,000, which means that A Limited made a profit of 20,000 Rand. This is intergroup profit, because when I consolidate A and B, can A sell to B? No. Did A actually sell the land to B from a consolidation perspective? No. It's as if the piece of land stayed within the same company. There was no sale. There cannot be a sale if A and B are one entity. So what about this profit that A Limited made? For group purposes, it doesn't make sense. So what do I do with it? I need to eliminate it. And how do I eliminate it? By passing a consolidation journal entry. So what consolidation journal entry do I need to pass? Well, the first step is to determine in which account is this 20,000 Rand sitting? Because I need to know in which account the 20,000 Rand is in the books of A to know from which account I must take it out of. A Limited would have recognized this profit of 20, and this profit of 20 would be sitting in A Limited's other income. So where do I take it out? From other income. How do I take it out? Well, we go back to our good old T accounts, and we know that assets increase on the side. We know that liabilities increase on the credit side. We know that income accounts increase on the credit side, and expense accounts increase on the debit side. So, other income is an income account. We know we want to reduce it by 20. If I want to reduce an income account by 20, must I credit it or must I debit it? I must debit it. So I know the first leg of my journal is to debit other income with 20. What about the land or the PPE? It's currently sitting in B's trial balance at 120,000. Was there a sale between A and B? No. So if there wasn't a sale between A and B, can I increase the value of the land from 100,000 to 120,000? No, there's no reason to, because there was no sale. So how do I get this land down from 120 back to its original carrying amount of 100,000 Rand, as if there was no sale? Well, I can go and have a look and I say, okay, land is an asset. How do I reduce an asset? I credit it. Credit property, plant and equipment with 20,000 Rand. So do you see that consolidation journal entries are nothing more than adjusting accounts in your trial balance? The only difference is, instead of plussing and minusing, you are using debits and credits. Okay, at the acquisition date, you will need to determine whether there is goodwill or gain on bargain purchase. What is goodwill? Goodwill is an asset. Where do assets get disclosed? In this statement of financial position. What is gain on bargain purchase? Gain on bargain purchase is an income. And income gets disclosed in other income if it arises in the current year, and retained earnings if it arose in a prior year. I need to tell you at the beginning of this module, before you get into it, that you need to know where things are disclosed. Let's say you calculate goodwill using the analysis, but you don't disclose it as an asset in the statement of financial position. When we mark your exam paper, we will not mark that calculation because it's not disclosed. And what I mean by disclosed is showing the amount in the financial statements. If we take another example, let's say you calculate non-controlling interest. Now you all know that you can use the last column of the analysis to calculate non-controlling interest. So let's say you calculate that non-controlling interest using your analysis perfectly, but you don't show non-controlling interest in the required section. So for example, let's say we asked you to do a statement of profit and loss, but you don't show the profit attributable to NCI in that statement of profit and loss. So you don't disclose your calculation of non-controlling interest. You will not get any marks for all that work and calculations that you put into doing the analysis. So please remember, very important, if something is not disclosed in the financial statements, we do not mark that calculation. Let's have a look at a little example. This is going to be the last example to determine goodwill or gain on bargain purchase. On 1 January 2018, the issued share capital of Toad consisted of 100,000 shares with a market value of R6 each. On this date, Frog Limited acquired control over Toad. By now you know that word is extremely important because that tells us that Frog is a subsidiary of Toad. Okay, if it wasn't for this word, we would not know because you can't look at shareholding. With the purchase of a 70% interest in Toad at a cost of R420,000. The equity of Toad consisted of 100,000 Rand share capital, retained earnings of 470. All the assets and liabilities of Toad were at fair value except for land, with a fair value of 840 and a carrying amount of 820. Toad Limited uses the full goodwill method. Okay, if you need to, please pause this production and just read through the required information again. I'm now going to go on to the solution. Okay, there are three ways in which you can calculate gain on bargain purchase or goodwill. Please note that in an exam or an assignment, we can ask you to do a specific method. So for example, we can ask you, calculate the amount of goodwill using the analysis of owner's equity. We can say, or calculate the goodwill by using the proof of goodwill method. Or we can say, calculate the goodwill by using the consolidation journal entry. Please note that any of these as well can be discussion questions. We can ask you to discuss how to calculate goodwill in terms of one of these three methods. So at acquisition, we know the share capital of our subsidiary is 100,000. The retained earnings is 470. Then we have land that had a fair value of 840 and a carrying amount of 820, which means we're going to revalue that land upwards by 20,000 Rand. A lot of students ask, but this is an asset being revalued. What effect does this have on equity? Well, the answer to that is if we have a look at our accounting equation, what are we doing to our asset? We are increasing it by 20,000 Rand. What effect does this have on our equity? Increases it by 20,000 Rand. So because of our good old friend, the accounting equation, is why this revaluation of land upwards by 20 has a direct effect on the equity of Toad at the acquisition date. Okay, you should all be very familiar with this method because this is the same method that you would have used in your second year, with non-controlling interest being at fair value because we're using the full goodwill method. The second way is to use the proof of goodwill. This is the way the standard tells us how to calculate it, where we start saying the consideration paid, we paid 420,000 Rand for our investment. The NCI at fair value is 180,000 Rand, which is the number of shares the NCI owed times market value per share. And from that, I deduct the equity of the subsidiary at the acquisition date, 585,520. That is simply the share capital, the retained earnings, plus our equity that increased because of the revaluation. We get goodwill of 14,480. Notice that's exactly the same as the goodwill that we calculated using the analysis. And finally, the last way to calculate goodwill is to use a consolidation entry. We're going to debit the share capital of the subsidiary, debit the retained earnings, and debit the revaluation surplus. Why do I debit these? If you remember from your T accounts, if I debit an equity item, I reduce them. Now I need to eliminate all the equity of the subsidiary at acquisition date, because only equity earned after the acquisition date can be part of the group's financial statements. So how do I get rid of the equity earned before the acquisition date? I debit it. I'm going to credit my investment at cost, credit my NCI at fair value, and my balancing figure is going to be my goodwill or gain on bargain purchase. Because it's a debit, I know it's going to be goodwill, an asset. If I balanced on a credit, it would be a gain on bargain purchase, in income. Why do I credit my investment at cost? Because Frog and Toad are one entity for consolidation purposes. Can I have an investment in myself? No, but what is in the financial statements of Frog? An investment in Toad, isn't it? So how do I get rid of that investment in Toad line item? Well, investment in Toad is an asset. How do I reduce an asset? I credit it. NCI at fair value, my non-controlling interest, forms part of my equity section. I'm bringing in my non-controlling interests of 180. How do I increase an equity item? I credit it, and hence the credit. I really want to stress, please don't be scared of journal entries. Don't be scared of debits and credits. If you understand why you're debiting or crediting something, all I'm doing is, instead of saying plus and minus, increase and decrease, I'm saying debits and credits, keeping in mind assets increase on the debit side, they decrease on the credit side. Thank you for listening to our first broadcast. We're sure it will be one of many, so you will hear from us again. Please let us know via email if there's anything specific that you would like us to cover in these broadcasts. And again, thank you for listening, and please let us know if you have any questions on this or any of the study material. Thank you. Bye-bye.